Thank you very much. Hopefully you see my screen now. So
Yes.
let me get going. So this is, I'm going to present this paper, Tough Talk. It is a description of the type of communication we're going to analyze, not how difficult this is going to be for you to sit through. This is actually This is joint work with Anna Chislak. And actually, in many ways, Anna gave this seminar a couple of sessions ago, maybe two. And this is like a part two of that project that you saw before. So I'm going to, ride on her coattails and hope some of you remember the stuff you saw then. So what's it really about? Well, there's this famous quote from Ben Bernanke. It was actually in his first Brookings blog that he wrote, where he talked about central bank communication. And, lots of people cite this. The sort of monetary policy is 98% talk and only 2% action. In that first blog, and in fact, in the same paragraph, in the same lines, the first paragraph of the blog, there was another bit that people don't talk about so much. And that is when he talked about the cost of sending the wrong message can be high. So that's really what this paper is going to be about. It's going to be, how does Fed communication, this practice, which, maybe if you're a bit older like me, you think this was fairly recent ago. If you're some of the younger researchers in the audience, you think this sounds like ancient history. But, 30 years ago, the FOMC was not even announcing its decision. Now we get lots of talk from central banks, the Fed, the Bank of England, ECB, Bank of Israel, etc. Question is, how does that communication affect risk premia in financial markets? That's sort of the big picture question. Now, why would we be interested in this? Well, if you look, there's not a clear prediction on exactly how the Fed's communication should affect premia. And we'll talk a little bit more about that, but there's sort of theoretical work that can predict both sides depending on what they signal. We have empirical evidence right now, but the majority of the empirical evidence points to the idea that surprise easings reduce risk premia at FOMC announcements. And Bernanke-Kuttner is a sort of a well-known paper with that result. But again, with the theory, but also just thinking a bit yourself, that doesn't have to be the case. And also, you can imagine a world where if this was the case, this would be pretty tough, right? We've seen a lot of central banks who, after inflation sort of picked up and stayed higher for longer than had been expected, they suddenly had to pivot, and it would be kind of potentially worrying if the way they moved rates would differ on their effect on the overall economy, whether they tightened or loosened at different points in the cycle. So we're going to sort of look at that a bit. And one reason as well that we might get that result is that a lot of the evidence is based off FOMC announcements. Again, an important part of the monetary policy communication. But we know that in our empirical data sets on surprises at FOMC announcements, we have a bias towards negative surprises, namely that when we hit downturns, the Fed has consistently eased more than had been expected. And this is, Anna has this in some of her earlier work, but there are other papers along the way. Schmeling, Schrimpf, and Stephenson and Baron Swanson all make this point as well. Okay. What we argue in this paper is that essentially the big part of the risk premia that the Fed wants to worry about is the bit that it can control, namely when there are perceptions that it might be making a mistake. This is something that the Fed may want to worry about. Of course, there are many other things that go into risk premia, and many of these are completely outside the remit of the central bank. And it's right that assets are priced taking into account their risks. But if you're the central bank trying to control financial conditions, one thing you want to minimize is sort of wild swings in the likelihood that the market thinks you're making a mistake. And we argued that by talking about how they can take a different from current policy. And in the sample that we look at, this was largely a concern that the Fed was falling behind the curve. This was, we're going to look at the sample sort of through Greenspan, Bernanke, and up to part of Yellen's time. And during that, most of that sample was still a world where we worried that central banks would let inflation run loose, rather than perhaps more recently, or if you were the Bank of Japan tuning in, a period where their worries were you would not be able to get inflation up. So in that world, tough talk, namely, if we need to, we will tighten, we will, take tough action, can help by alleviating worries in the markets. And just to I'm going to sort of diverge for like 30 seconds to a minute just to sort of talk about a more recent period. And you can kind of see it in this plot here. This is the period immediately after the start of the COVID pandemic, and then in through 21 and into 22 as inflation took off in 2021. You can see that although the Fed communicated very clearly that it was not going to be adjusting rates, it's forward guidance. I think we've argued with other work with Anna and Hao Pang. We've argued that they were very credible in that regard. You do see that markets, at least in the 10-year yield, were starting to price much higher interest rates. Now, what is this? This is about over a period when the Fed is trying to keep rates low. This is a tightening of financial conditions of somewhere around 75 basis points, maybe a little bit more. And so, thinking about this, why should we care? Actually, if we think inflation is starting to go up, then shouldn't we be happy that the market is doing some of the work for us? Well, I actually argue very strongly against that. I think we really want our central bank to be the one that induces the big swings in financing conditions where it comes to issues like control of inflation. As I said, if there are other extraneous risks that they can do nothing about, then fine, the market has to price those appropriately. But if you think about it like this, what we're trying to control is something like a 10-year real rate. This is going to matter a lot for investment, for households, etc. Then the components of this are obviously the things we always think about, the sort of the path over the 10 years for central bank interest rates. Because we're thinking about reals, we have to think about how people expect inflation to behave over that 10 years. And then there's this sort of term premium or risk premium that might be going on, which involves lots of risks. As I said, I don't want to pretend like the only risk here is the risk of a central bank mistake. But if you signal that you're going to stay dovish, keep rates low for long, and the market thinks that might be inappropriate, then you can see a world where this term premium or this risk premium starts to increase, and that tightens financial conditions, even though you don't want it, right? And that's the picture I showed you on the last slide, and I'll show you a bit more in detail through the talk. Now, you may think that's good because it does some of the work for you, but actually, what if they become convinced that you'll be very dovish? Well, then you're going to get all sorts of things going on. In particular, whatever, they'll shift the path for the expected interest rates. They'll also start adjusting inflation expectations up. Moreover, if they start worrying about this a lot and they think you're just not very good at, reading the economy and choosing appropriate rates, you're going to get volatility in both inflation expectations and term premia. And you can see that both of those, if they're more volatile, they essentially weaken the grip of the central bank and its policy path on controlling the financial conditions that matter. So that's a reason why we think you should worry about this if you're a central bank. Okay, I'm not going to go too much into the literature, but just to say, look, there's a huge literature, as Jonathan was alluding to, on central bank communication, on the monetary news, about changes in expected rates. There's a whole literature on information effects and, sort of essentially signals about the fundamentals. And then there's, what we're going to look at is this idea of risk premium news. And again, there's a literature mostly in finance, but increasingly in economics that thinks about these things. Now, one thing that's worth saying up front is these things are not exclusive. So, in fact, in earlier work with Stephen Hansen and Matt Tong, we talked about a world where the central bank sends signals, so fundamental news, so line 2 here, sends signals about the riskiness of the economy and that this could then turn up in risk premia. The other point that we make in this paper is we are going to move towards a world where we acknowledge that policy making happens continuously between meetings. So any of you who've ever used sort of monetary policy surprises data around announcements of any central bank will note that they are typically very small. So by the time we get to a bit before the meeting, the market's usually within 2 or 3 basis points of the actual choice that's made. And so we get a lot of these surprises that are very small, but actually between meetings and as news comes out, there's a lot of action in these rates. And that's what we're also going to talk about. And like I say, there's increasingly work that's started to think about this. And I think it's an important direction to go in. Okay, so what do? We're going to take what you saw Anna do before. We're going to look at the Fed's internal stance. And you can think about that as being from the transcripts. And as she talked about before, the nice thing about the transcripts is we can split out when they're talking about markets, when they're talking about the economy, and when they're talking about their stance. And then we're going to, rather than look at just the on-impact effect, which is really what a big bulk of the literature does, we're going to think about how the policy stance that's discussed in the meeting, but not in the statement, how that comes out in what we call communication refinement. So you can think about this as speeches by policymakers. Of course, there's the minutes. There's also sort of informal communication when someone is giving, a TV interview and they make a comment. And what we're going to show is that these communication refinements, and in particular, those that communicate the different from current choice stance, are going to have this effect on financial markets through the risk premia. So that's what we're going to do. In order to show you that, I'm going to have to show you 3 things. I'm first of all going to have to show you how we identify the forward-looking stance. This is going to be easy with this audience largely because a bunch of it is going to come from what Anna talked to you about before. We're then going to need to identify sort of daily measures in risk premia and expectation news. And for this, I'm actually going to lean on Anna's previous work with Hao Pang. And I'll talk very briefly about that. And then I'm going to be able to get into the point of linking the two and talking about how the different communication of these policy stances actually makes predictions on particularly risk premia news. Okay, so that's where I'm going. Takeaway, we actually find the opposite. But again, we're not surprised by this, of the effect that is the predominant one in the literature from surprises. We find that forward-looking hawkishness, this is the kind of tough talk, predicts risk premium declines. And I'm going to emphasize this a lot today. This is not a sort of systematic Taylor rule response kind of effect. And it's not something that we're just merging in some new on-impact effect. We're going to think about this as separate to that. And I'm going to even show you there's no on-impact effect of what we measure. And I'm going to argue and show you that this effect builds over the intermeeting period and then link it in the final part of the paper to specific communication events like speeches and minutes and show you how this thing accumulates. That's sort of where I want to go. What's the sort of policy takeaway? Well, my policy takeaway for this is you should, as a central bank, you should worry a lot about the fact that the markets think you're credible. Now, there are many definitions of credible, but one is the sort of old blinder one of you will do what you've said you will do. Here we're thinking even beyond that, that your analysis is credible, that your read of the economy is credible, that you acknowledge the risks in a credible way. It's not very sensible if you come out and say, we are certain that inflation will be transitory, only for it to be, looking more and more persistent. So these are the sort of things that we're identifying. And why do we get that it's the tough talk that lowers these? Well, because over this particular time period, the sample specificity is that we've had on average a concern of 2 dovish central banks. And you can think about many periods, including immediately after the financial crisis, when central banks threw the kitchen sink at easing conditions. Some markets were thinking, gosh, well, this could be a big policy mistake that leads to a huge impulse of inflation. But actually, you can even go back before that. And those of you who are old enough will remember the period in the late 90s when the Fed held rates low and Greenspan argued very strongly against a lot of pushback that the growth that we were seeing in the US economy, strong growth in the US economy, was driven by productivity improvements and so would not be inflationary. There were many who thought he was wrong on this, and when it subsequently turned out that he was right, he gained the title of the maestro. But actually, over that period, if you look, and he's not usually known for his communication and his FOMC's communication over that period was one assuaging concerns and trying to say, well, look, if we're wrong, we will tighten, we will make it, we will make conditions tougher. Okay. So let me start with a very simple framework. In the interest of time, I'm going to do this very quickly, but you can read it in the paper, what we sort of have in mind. Think about a world where there's some kind of macro block. This is backward looking just to make it nice and easy to solve, and that this is the Fed, the market's perception of the world, and they believe the Fed follows some kind of simple rule, where the epsilon here is what we often call the monetary policy shock, but here we're going to link it to a mistake. Now, you can solve in the paper and you can show that what matters for the pricing of assets, both bonds and stocks in the model, is the variance of the sort of output gap term. And this depends on the variance, for the market's point of view, the variance of the demand shock that we've included. And we don't throw a cost plus shock in the main model, but there's one in the appendix. The period we look at is mostly one where it was demand shock concerns, but not exclusively, of course. But also the sigma squared epsilon. This sigma squared epsilon is the volatility of the monetary policy mistake term in equation one. And I'm going to show you explicitly where that could come from as mistakes. But then you can sort of show that this matters for the risk premium on stocks and bonds. I don't really have time to go into it. But the one thing I will emphasize is that the way you derive these results, you get that there is that the type of channel that the mistakes have is one that affects both the risk premium on stocks and bonds in the same direction. So we're going to call it the common risk premium, as opposed to another which Anna and Howe identify, which they call the hedging risk premium, which is where they move in opposite directions. Okay. But for now, let's just think about what the source of this. I'm going to skip through this. You can look at the slides later. I want to talk about the sort of the interpretation of monetary policy shocks as disagreements or beliefs about errors. And this is in Galli's textbook. So this is not us completely making this up. It's not the one we usually talk about. So what, and Caballero Simsek have a much more detailed sort of model of information and disagreement and difference in beliefs. But for a simple illustration, let's just look at this. The market has some belief given by phi x by x, the output gap, and phi pi by pi, and that's their sort of ideal policy interest rate in their belief. And these are their particular parameters and their beliefs about the state of the world. But they think that the Fed has different beliefs about potentially any of these. So they can have a different coefficient, they can have a different belief about the output gap, and so on. And if you sort of then look at this, you see immediately that what the market sets, what the central bank sets is what the market thinks they should set plus an error. And then if you sort of just grind through the maths, you can show that the error relates to any of these points where they may differ in their beliefs. And we're going to just think about two of these, but again, that's just for simple illustration. So one is they could differ over their beliefs about what shock has hit. Is it a net demand shock? Is it a big net demand shock, small net demand shock? These can be different beliefs. And once you have different beliefs on the demand shock, you end up with different beliefs on the state of the output gap. Okay, so that's one place where you can disagree. The other is you could disagree over the appropriate reaction function coefficient. Here we put it on inflation. Again, we're going to make it easy and assume that they all agree on the reaction to the output gap. Although again, remember, they don't agree on the output gap. So we're going to get sources of errors from both. And you have this sort of deviation from optimal response that they have. Then you can sort of break the monetary policy shock into a component related to shock assessment errors from the point of view of markets, and a belief about reaction function errors. And of course, these beliefs about errors interact with coefficients that we agree on or inflation that we agree on. But again, you can make this more complicated if you're interested in that. So then what we're interested in, if you remember, is what the variance of this monetary policy shock is. That's what's going to matter for the risk premium. And what we can do is we can sort of put a little bit more structure on this. We're going to assume that these two potential errors are uncorrelated with each other and uncorrelated with economic conditions. Again, you can add those back in, you just get more terms. And you can then derive explicitly what this variance term that drives the risk premium looks like. And if you impose structure on what the shocks are, and again, there's many variants of how you think the Fed might be making mistakes. You might want to believe this is a one-sided error on the coefficient, but this is just for completeness. You can assume that there's some probability that they're too dovish, and there's some probability that they're too hawkish. And these P and Q are things that you might be able to affect by communication. Grind through the maths and the sort of this mixture model, which you can work out the variance of these terms, show everything in it. What do we end up with? We end up with this variance of error terms, the thing that drives the risk premium, as depending positively on concerns about their economic assessment. So in other words, if you believe your central bank doesn't know how to read the state of the world, you think they're going to make more mistakes. If you think they're going to make more mistakes, you have to build in risk premia into your pricing of assets, because you're going to have inappropriate output gaps because of their policy errors. Or you can have concerns about their type. Now, the concerns about the type have these two particular forms. And if I go back one, you can see that these particular terms actually are functions of P and Q, as I said, which you can imagine as being affected by communication. And later I'm going to try and show you. Imagine a world where if P goes up, for instance, the market starts to think you're more dovish than you are, then this is going to drive up this variance term, which then again drives up the common risk premium. So that's sort of where we start. You can think about these errors. And this is a sense in which I'm going to talk about, maintaining credibility of assessment and maintaining credibility of your stance as being important and mattering for the risk premium. The corollary of this is that if they're worried you're too dovish, but you send them signals that you are either more hawkish or that you might become more hawkish, then you can assuage those concerns.
Michael?
Yeah.
We have a question from Fred Jawadi.
Yep, fire away.
Yeah, can you hear me?
Yep.
Yeah, I have two small questions. I'm starting by a general one. So we know that the ECB, the Fed, they conduct their monetary policy differently. They don't have exactly, for example, the same mandate. And then when coming back to this, the impact of the communication of the central bank on the risk premium. So I would say that, what about if the central bank targets more explicitly financial stability? It does mean the financial stability is at the center of the conduct of monetary policy. And while doing so, it could directly or indirectly better learn about the investor beliefs, the investor behavior, and then the rate that will be applied by the central bank could somewhat capture this kind of expectation or this kind of risk premium. So would this relationship between communication of the central bank and risk premium still hold for that kind of conduct monetary policy? This is my first question.
So potentially, but this is not going to be about concerns about financial stability. This is going to be signals on monetary policy. Now, if you think that central banks are conducting their financial stability interventions through the interest rate, so they're using it to cool the market, fine. That could equally be a reason you think they're being too dovish. You think they're having too easy a policy because you think that their policy is promoting financial instability. Same channel. The only thing that matters for the risk premium in this is volatility in the output gap, and the volatility of the output gap, which are essentially the consumption claims, they'll be affected. Now, we don't model them, so I can't give you this is the exact channel, but anything, if financial instability was one of the sources of risk and you were exacerbating that through being too dovish, then I think the same channel could apply. One thing that's worth pointing out, right? If the worry is that you're too hawkish, right? Imagine you're the Bank of Japan and they think you're too hawkish and you signal hawkish, you'll have the opposite effect, right? So again, the key thing that you learn from this is it's not about hawkish is right or dovish is wrong or vice versa. It's that wrong is wrong. You need appropriate policy. And if you want to think about appropriate policy coming because of financial stability, you could think about that. That's not how we've modeled it. And it's not what we're going to measure.
Okay, thank you. And then my second question is about one of your assumptions. So if you understood it correctly, so we suppose that the market beliefs of disagreement is not correlated with economic condition, right?
So it's the market beliefs that you don't think that it's always when the economy is weak that they always make a reading error. They make average reading errors. But again, if you don't like that, you can build it in. It just adds in extra terms. It makes the equation larger. It doesn't change the direction of the effect necessarily.
So if it does mean that if what could happen if in one let's suppose take this following example. First, so I have an economy for which the inflation is controlled. The inflation evolves around the target, and then the central bank will communicate on that. So I'm going to invest in the financial market. How I'm going to react after that communication, and they're taking the same example of central bank communication, but now we are in an economy for which the inflation is very high. So that means that the effect will be the same, whatever the level of the level of inflation, whatever the level of.
So I don't have. Okay, I'm going to move on from this just because you can rewrite these kind of models in many directions, and all of the predictions you can change if you make different assumptions about things. Okay, so. This is just for simplicity to point out why concerns about type could affect risk premia, and to point out that they could, even in this model, with these big, as you're calling them, kind of stringent conditions, they can still go in either direction. So I have not cooked it that it goes in one direction. If you want to think about much more complex error processes, you can do that. In fact, we've done that. Equation 5 becomes much larger and you have much bigger, like potentially offsetting effects, but that's not what I'm going to focus on.
Okay. Thank you.
Thank you very much, Fred and Michael, for the answers. Do we have additional questions? Okay, thank you very much, Michael.
Okay, so let me tell you what we do measure, and this I'm going to now go even quicker because Anna showed it to you before, and if you weren't here, you're going to have to catch with the summary. So we're going to take the part of the FOMC meeting in which they discuss policy, and we're going to measure something called HD, which is a difference between the hawkish expressions and the dovish expressions. Again, there's a whole series of linguistic rules by which we calculate this. The whole other paper that looks at its behavior, it predicts things nicely. I'll show you a few of those, but here's what it looks like as a picture. You can see that in some meetings, they talk mostly about dovish, like at the start of the financial crisis. Even at some meetings, they talk hawk and dove at the same time, and then they switch a little bit. But overall, you get something that looks like the graph on the right here, where you can see that particularly around recessions, there's largely a big fall in this HD score. Now, you can also see that when this thing falls, you tend to get rates moving. So the green is the actual Fed funds rate, the dashed line, which sort of moves with it for most of the sample. But then when we hit the ZLB, it's the shadow rate. You can see also one thing that I think is worth pointing out. Let me do it. here around the financial crisis, you can see that even though rates stayed low for a long time, this measure, which again is capturing meeting by meeting discussions, moves closer to balance pretty quickly. Okay, so by 2010, the FOMC is at times even net hawkish in its discussions, and that's what I was sort of referring to earlier. Now, I've said that what we are interested in is the forward-looking stance of other policies we might take. So how do we get that? Well, this is just a summary of the discussion. And again, just to show you some of this discussion does predict things like the Fed funds changes, even controlling for green books, or in another way of saying that, it predicts Romer shocks. And it goes in the way you would expect. Higher inflation forecasts, higher growth forecasts predict higher hawkishness. That's what we should take from this. What's interesting about it, this stance thing also predicts future moves in interest rates. So as you go half a year forward, being more hawkish today is associated with having higher interest rates in 6 months' time. Okay, so including controls for things like green book forecasts, etc. So there's something in this discussion variable that we think matters a lot. Larry Meyer has a nice quote about how when you're in one meeting, you're positioning yourself for future meetings, and we're going to treat that in that way. But what we want to do is we want to purge out all of today's decision on that variable. So to do that, we're going to run a regression which controls not only for the forecasts, but also for the interest rate chosen today and the interest rate lagged to the previous meeting. Now, what does that do? It actually gives us a variable which we call HD gap. So this is the difference between actual HD and that predicted by the state of the world and the decision. So when HD gap is positive, it indicates that the discussion was more hawkish than the actual decision and the state of the world. When it's negative, it suggests that the discussion was less hawkish or more dovish than those sort of contributory factors. Now, one thing that always jumps out is this big fall in the HD score around the period of the financial crisis. Well, you can actually see that around that period, the gap measure is actually not that negative, and even at times just before and just after, it's positive. So what does this mean? It means that yes, they were very hawkish, but they also took very hawkish actions. They cut rates aggressively. So what we're going to work with is that residual term. So this is what it looks like in variable, and clearly there's noise in here. So now let's ask whether, having purged out the announcement and the green books, in a way having purged out what they announce and any information effects that you might think are in that announcement, do we have anything left? Well, this is a series of various surprises that are regularly used in the literature. This is the Gerkenek-Swanson target and path factor, Gertler-Corradi, Nakamura-Steinson, Bauer-Swanson, and then this is Bauer-Swanson where they orthogonalize it to a bunch of things. And you can see here that our HD score does actually predict significantly some of these on-impact surprises. But once we move to the gap and we purge out the decision and the green books, you get no significant effect. So this is not about the sort of announcement effect. That's what we're trying to purge out. Okay, so we purge that out. Now, this could be a really dull talk ending immediately where I just say, and the noise that we're left with having done the purging predicts nothing. But that's not what I'm going to show. What I'm going to show is it does have effects, and it has very specific effects that relate to the channel I was describing earlier. So,
Michael?
Yeah.
Yeah, I just have a quick question about the previous slide. So when you say it predicts, you mean you do not mean out of sample, of course. You mean in sample prediction, like regression.
So these are the transcripts. This measure is derived from the transcripts, which is not known at the time of the surprises. Now, it's correlated with positively and predicts their behavior. You can't do it in a forecasting sense, in the sense it's a reverse forecast, right? Because this is a variable that was only publicly known 5-6 years later. But it was from the day of the discussion. So if we're going to have a discussion of whether this was known to markets, which is what you're suggesting, then you have to be in the world of leaks. Okay. This is transcript-based data, so it's not publicly known. That's why this could be a very dull talk.
I see.
Now, here we have purged that private variable of whatever is public. And whatever is made public, the announcements, and actually the Green Book stuff is not made public, but we have an entire literature that talks about them signaling this. In that world, then there's no predictive relationship even in sample. That's why it could be a very dull talk.
I see. Thank you very much.
Okay, so I'm just going to take this as what Anna and Howe have done. They basically decompose daily innovations in stock returns and yield changes at the 2, 5, and 10-year maturity into news about growth, about monetary news, and then into 2 risk premia, one called the hedging risk premium, the other the common risk premia. This is a paper that was published in 2021, but I'll show you some results. Essentially, the way you decompose into expectations versus risk premia is whether or not it has a bigger effect now than further out the yield curve. That would be expectations, whereas risk premia effects have bigger effects further out the yield curve than closer. And then the common versus hedging, or the monetary versus growth news, depends on the stock bond co-movement between the sort of the news that's given. It's negative with growth news, positive with monetary news, and then the common risk premium is positive, and that's the channel that we sort of identified in the model. I'll skip some of the data, just people can look in the paper. So here's the main predictive regression. So again, this is an internal variable that was not publicly known to markets, having taken that and purged out anything that they knew or we think they may have found out, which is the information effects. And this HD gap variable makes no prediction on impact on market behavior. Yet, if you look at the movement in the risk premium over the intermeeting period, so from the meeting where we have the transcripts to the next start of the next meeting, just before the next meeting, you get a fall in the risk premia that accounts for about 17. A 1 standard deviation increase in this HD gap reduces this risk premium by about 17% in terms of common risk premium, about 19% overall. Importantly, this gap term has no effect on expectations terms and no significant effect on monetary policy expectations. Again, you may think that's a little odd, but if I don't purge, so if I don't purge out the decision and the Green Book data, then you do get a significant effect. So some of that HD stance that we measure in the other paper is capturing changes to rates. But once you purge out rates and economic conditions, that goes away and you're left with this effect on the common risk premium. Okay. What to make of this? Okay, so, well, you might say, you've purged it out, but maybe there's a direct effect on risk premia of the Green Book and the Fed funds rate. Well, if you throw them in as controls here, you still get nothing on the expectations terms. Directly, but the effect you get is similar. In fact, it's slightly larger if you use HD and control indirectly for these things. You might say, Michael, I don't like Anna and Howe's decomposition. Is there any other way you can show this? Sure. We could go to the Kim Wright decomposition, which again has a completely different way of decomposing into the premium and the expectations term. And there you get a very similar effect coming entirely through the risk premium. Okay, similar magnitudes, similar channel. The important bit is that so we've been showing the results using the entire intermeeting period. If you gradually look at the effect over time, so over days in that period, you see that the impact effect and even the near effect is basically zero. And it's only once we get out 10, 15, 20 days that we start moving towards a sort of big decline in the risk premium. And ultimately, it's only when we're sort of at 20 something days, 22, 24, etc., that you have results that look like the overall intermeeting effect. So again, just to stress, this is a variable which is based off data that's not released for 5, 6 years. It's released after 5 years, but it waits till the December. So the January meeting is basically 6 years old. The December meeting is 5 years old when it's released. And we purge out the stuff that does get released and even some stuff that doesn't. And that what's left has this predictive effect on the risk premium over time. So now you may say, oh, but that probably happens with all of these sort of surprise measures. No, it doesn't. If I do the same type of focus, H equals 0 is the impact effect. You can see you get these effects of path or the LSAP surprises. This is with Eric Swanson's disaggregation, again, with a bunch of controls. As we go through time with those, the effects fade. So you get nothing by the time you're at the whole intermeeting period and even nothing after 2 weeks. Ours, the effect builds up until the intermeeting period. So again, I think this idea of thinking about announcement effects versus all the continuous updating is an important thing that we're starting to do in the literature, but should be done more. I'm aware of time. Let me do 2, 3 more little things.
Feel free to continue. I can allow you 10 minutes or 15 minutes more. No problem.
Okay, well, let me take at least 8 of it, and then I'll stop. You can ask whether this is happening because it's all coming when they're cutting anyway, or something like that. It's actually not. If you split the sample into different chunks, you see that the biggest effects are when they have not been acting at all. So it's precisely at times when the Fed has not been moving in the last 3 meetings that these effects are big. There's some effect when they've acted, but it's larger when they don't act. So this is at times when they're essentially not moving rates, and this is probably the time that the market starts to worry that they should be moving and they haven't. I'll skip that in the interest of time. I'll skip this one. The key thing now to finish with is this idea of why might it happen? Well, it might happen because although we've focused on FOMC decisions a lot in the literature, the intermeeting period is filled with information. You have all the macro data. So if you wanted to know whether I had made a mistake in my prediction that inflation was transitory, you might worry that the inflation release is going to be the most important thing. I could be silent the whole time, and you could decide I'm a genius or an idiot when the inflation comes out and is still high, then I'm an idiot, or if it falls back, I'm a genius. Okay, so you get these effects, macro data. The minutes, of course, are a longer, more detailed discussion of what the policy debate had been like. So it could be coming there. And of course, individual policymakers make many speeches. So I'm going to look at those now.
Michael?
Yeah.
We have a question from Ridula Dugal.
Hi, Michael. Thanks, Jonathan. Can you hear me?
Yeah.
Okay, I possibly might have missed this, but when you're saying that more hawkish behavior is related to reducing term premia, does this factor in that you could be making a mistake being a hawk?
So I said when I presented it that it could go either way. It's just in our sample, it does not, on average, predict that.
Okay, perfect. Thank you.
So, but in theory, you're absolutely right. In theory, I could be too hawkish. And I gave the example earlier of Japan. Japan, for a long time, has been trying to signal dovishness to convince markets that they will generate enough inflation. But the sample we're looking at, which runs from Greenspan all the way up to 2016, that was a period where, for most of that, the concern in the US, but also in Europe, in the UK, a lot of that period was a concern about inflation being allowed to take off again and go back to the 70s kind of level. But absolutely right. You could signaling hawkishness when the market thinks you're too hawkish would increase risk premia in our world.
Okay, thank you.
Okay, so this chart just shows across our sample when information is released and how much information is released. And you can see that around announcements, they tend not to have a lot of speeches. It may surprise some of you that there are some speeches, even up to a few days before the announcements. These are speeches. So there's a thing called the blackout period, or PERDA, or some other name that they give it in different central banks. That doesn't actually say there are no speeches. But the speeches that the board members are allowed to give have to be unrelated to monetary policy. So they can talk about community banking initiatives, they can talk about other things. Again, I'm not saying there's zero information in that, but it's not going to be the main signal of HD. But you can see that there are lots of speeches. So on average, about 16 days out in our sample, we have over 60 speeches by board members. And just to be very clear, the speeches that I'm showing here are just those of the board. We don't have all the president's speeches in here. We've been working with them elsewhere, but they're not yet in here. But you can also see that up until 2005, the minutes were released close to the decision, but these are actually the minutes from the previous meeting. So they used to make a decision at time t plus 1, they would make another decision, and then they'd release the minutes of time t, not t plus 1. That's changed. So since 2005, it takes about 2 to 3 weeks before we get them. These are the red dots, and you have lots of minutes released, 15 days, 14 days, etc., from the event. The gray in the background here just shows you the sort of the point estimate without the error bands of our building regression, and you kind of see that the effects build over this period. So again, if you're thinking about this as a cumulative set of signals you're receiving, that's where you could be getting it. Are the statements reflective of the transcripts? Yes. The statements less so than the minutes. There's more information in the minutes. Shouldn't surprise anyone who's read them. If you repeat our regressions and try to predict the intermeeting common risk premium with transcripts and the minutes and the statements, again, you get the biggest effect is still driven by the transcript. So there's something in the minutes, but there's not once you control for the transcripts. Okay, so there's some information there that comes. If you do the same thing with speeches, and now the challenge with speeches is the signals are much noisier, and actually the amount of speeches in a period starts to matter. You start looking at sort of bigger and smaller windows. You do get that, at least in theory, we can't do the full decomposition of the effect because we don't have every speech given, and we don't have sort of potential moves that interact with, say, macro releases. But you do get that there is a sizable effect, a hawkish. So this is now a raw measure of the hawkish scale, but we include the Green Book and the Fed funds rate as controls. A hawkish speech in a given window will predict a sort of decline in the risk premia, and with enough speeches you can aggregate up to the total intermeeting effect. So again, should this surprise us? Probably not. What's likely being picked up by our HD gap measure? It's the fact that we have a meeting where maybe 12 members all agree and they talk in one particular way about the required interest rate, but there's a subset of members who want to be more hawkish. Now, once we purge out the decision, which might be no change in rates, we're going to find that that meeting looks a bit hawkish in the gap measure. But the statement is going to reflect the majority view, so you don't get much on impact. But as these hawkish members go out and start telling the world, hey, you know, we actually are worried that we're not moving fast enough, we should raise rates, we might be behind the curve, then if the market is worried about you being too dovish, this will somewhat at least assuage their concerns, because there's someone around the table who's worried about the stuff that you are. What would really worry you is, Merdula, this is related to the point you just made, if you're worried that they're too dovish and then all the signals you're getting are super dovish, then you could get things go the other way. Okay, so let me wrap up here. Again, sample specific in a period where the major concern was that the Fed might fall behind the curve, and in particular, there was a couple of episodes where they had gotten inflation under control, but then they kept rates relatively low by market interpretation. That's a world where tough talk and hawkish talk can actually assuage concerns and pull down risk premium. And the way you do this is through the intermeeting communication, not necessarily the announcement. This is exactly the point I've made a few times. You know, how can we explain the Bernanke-Kuttner result? Well, that's another world where, on impact, the market is worried about the economy. Those big surprises that we have in the data tend to be around major recessions. So at the start of the financial crisis, the market worried that we were going to have too tight policy, potentially for an economy that needed a massive cut. And what they got was really aggressive policy, and in fact, more than the market was expecting. So that's good, right? The central bank is still assuaging the concern of mistakes. It's just the mistake was in the other direction. Okay. I'm going to end with these, with the two quotes. You know, why do we worry about this? Because yes, talk matters, but the cost of sending the wrong message can be high. And in particular, in the world with term premia, policymakers' grip on the steering wheel is not as tight as it otherwise might be. And the sort of policy implication is that you do want to control that a little bit. I'll stop there.
Thank you very much, Michael, for this excellent presentation and very interesting paper. So we have several questions already. Please feel free to raise your hand if you want to ask a question. We will start with Eliezer Borenstein from the Bank of Israel.
Thank you. Hi, so first of all, thank you for the presentation. It was very interesting. I have two questions, which you may have addressed and I missed, so I apologize if I did. One is, there's a paper by Becker et al. 2013, I think, where they show that easing monetary policy causes a reduction in the risk premium. So I was wondering, suppose, for example, in your sample that isn't the case, but suppose that you would see that after a dovish, more dovish information that comes out to the market, risk premium goes down. According to your paper, I think you would interpret that as people thinking that indeed a more dovish policy is what is good for the market, is the appropriate policy, whereas Becker et al. Would claim that no, it's just about more dovish, being more dovish reduces risk premium by, I don't know, the effect that it has on increasing asset prices and calming the market through that or so. So I was wondering if I'm correct, how can you disentangle these two explanations? The second question was, wasn't clear to me in the model that, if I understand correctly, risk premia in your model is related to the question whether the Fed conducts the appropriate policy. Whereas I would think that risk premia is by and large affected by predictability of policy. So for example, if the Fed chooses a very, very bad course of action according to the public, but it's mainly predictable, that wouldn't be necessarily reflected in premia, but rather in the prices of the assets. So I'm not sure if I was clear, but that's something that I wasn't sure about. Thank you.
Okay, so let me give you the quick answer to. So I don't know the paper you're talking about, but it's not without possibility. There are times when the appropriate policy is exactly to be more dovish, and that would lower premia. So how would you distinguish between the two? So if you just had pure loose policy, right? I just send a loose policy signal, and we just want to figure out the effect. I don't believe that that has the effect on the common risk premium, because it would boost stock prices, but what it does for inflation and therefore yields should go the other way. So I think this distinction between hedging and common risk premia is one place where you could go. But since I don't know the paper, I don't want to claim a universal victory. I just don't think it's not at all inconsistent with what we have to find that a central bank can be dovish and, you know, lower risk premia. In terms of, I mean, we obviously focus on the channel being the appropriate policy, and I guess it's sort of my fourth slide, but not used. It's just my own thinking point. How you imagine that mistakes turn up as premia versus expectations of lower rates versus expectations of higher inflation, I imagine is not immediate, right? So you can think the Fed is making a mistake, but it's inherently an inflation fighting, you know, it's the Greenspan Fed. It's just they're misreading things right now. But long term, I don't distrust the Fed and think they're a disaster. That's a place where I think you would see a distinction between things turning up in term premia. If you are I don't know, Argentina or some other country that has a much less well-established, credible record for fighting inflation, I could imagine that mistakes turn up in expectations and expected inflation more quickly. Again, I'm giving that as an answer from my intuition, not from a study I have done, but I could imagine that that's the case. You certainly see it if you look, as Anna Howe and I have done. If you look at the period when inflation took off recently in the US, risk premia went up, but actually expected inflation, especially longer term expected inflation, didn't really go up. So my interpretation of that is you learn that the Fed is a bit behind the curve, but you ultimately believe they will recognize this and, you know, catch up and fight inflation. It might take 3 years or 5 years, but you don't suddenly believe the Fed has become, I don't know, a sort of a dovish Fed that will allow inflation to hit 10%. And so that's how we interpret the recent data. And I think it's consistent with this view that where worries turn up could be different in different countries, in different scenarios. Gosh, I don't know. We have an election tonight in the US. You know, the appointment of particular people to the Fed, you know, could destroy some of their inherent credibility for inflation fighting. So, look, I'm based in the UK. We had our little episode 2 years ago where the UK decided to become an emerging market temporarily, where we decided that credible institutions didn't matter, and markets reacted very aggressively there, and, you know, endogenously institutions came back into focus. So yeah, I think, but let me just make what is perhaps the most important comment in response to this, which is I think this is an area that we've somewhat lost sight of in a lot of our macro. If you go back to the 80s and earlier, we had lots of models of credibility, endogenous credibility, and what matters. You know, Alex Kuykerman is a leading light in that literature. Now, obviously, as our models have gotten bigger, we've imposed a lot of credibility, right? We communicate perfectly the state of the world. We communicate perfectly our reaction function. And then we have a lot of other things going on, and that's fine. I don't know. I like the literature that thinks a little bit more deeply about the credibility stuff. So if there's a sort of an open area for research, I think it would be to try and disentangle, you know, my answer from your suggestion, and do that a bit more appropriately than I can do apart from off the cuff.
Great, thank you very much.
Thank you very much, Michael, and Eliezer for the question and Michael for the reply. So we have another question from Fred Jawadi.
Yes. Okay. Yeah. Thank you so much, Michael, for this great presentation. My question is about whether you control the model against the ability of market participants to anticipate that signal from the central bank. For example, suppose that I'm looking at the communication by the ECB, but that communication will follow that of the Fed. So I have already an idea about what the Fed announced, and I'm going to expect or anticipate what will be announced by the ECB. So I want to say whether in that situation the model still captures significant relationship between that communication and the risk premium. And taking a second example, for example, we're looking at the position of the central bank with regard to the climate change. We know, for example, that central bank do not want to green the monetary policy, while other banks are talking about that, including the Central Bank of England, something like that. So, when taking that kind of example, I would say whether this central bank signal should this still be significant to impact market behavior and risk premium. Thank you.
Okay. So the empirical model is just for the Fed, and I don't think that anyone thinks the Fed follows anyone. I might be wrong.
But on other sense, I mean on other sense.
So the effects, we only look at the effects on U.S. behavior. So if you think that there's some feedback coming through ECB reaction to Fed decisions and that comes back, potentially that's in there, but that's a sort of question on the empirical model and the way in which the decomposition into news shocks is done takes into account the lagged effect of all the other asset prices on it. So if there's a consistent dynamic of asset prices driven by the channel you're describing, that's picked up. If it's a kind of one-off thing, it will turn up as news in the model. You know, either monetary news or risk premium news or whatever. But disentangling it beyond regular stuff, it's going to turn up as signals. On the point about climate change, I don't think for most of our sample, climate change was a big thing. For monetary policy, climate change has been a big thing for many aspects of human life, but not for central banks. You know, if you take, for instance, I think the Bank of England was one of the first that spoke about climate change under Mark Carney, and that was really towards the very end of our sample. Now, where do I see this affecting things? As I said at the start, there are some risks that are in these assets that have nothing, in my view, to do with monetary policy. So risk premia could go up or down because of changing risk of extreme events or anything like that. I don't necessarily think it's monetary policy's job to control those. Where the
it is not exactly the position of the ECB when you look at what the communication by Christine Lagarde.
I'm coming on, but sure. So where do I view this as potentially dangerous is if you spend a lot of time focusing on climate, which is not your core objective. And there are aspects where climate interacts with monetary policy, the effects on inflation, there's questions about market operations, sure. But if you say that your job as an unelected technocratic central banker is to try to somehow affect government policy or the behavior of the economy with regard to with regard to climate change through central bank policy, I think the risk there is that you get distracted from thinking about inflation. And that would be a risk that in my world would turn up as higher risk premia because you end up not tightening rates enough because you're thinking about climate. Look, I think climate is the most existential crisis the planet is facing, but I just don't think that monetary policy is the number one tool to fight it. And if we want to use a tool to fight it, then it certainly shouldn't be central banks who decide it's their job to fight it. We want elected officials to say, your job is this. But then again, we always should ask the question. There's lots of things that monetary policy has impact on. Just because it has an impact on those, it doesn't mean it should be designed to address those. Inequality. The main channels of monetary policy operate through an inequality. If you're a borrower and rates go up, that's bad for you. If you're a saver, it's good for you. The reverse is true when they're lowered. We know there are effects on inequality, but if it is my desire to affect inequality as a government, I have fiscal policy, transfers, etc., that can do that much more efficiently and effectively than monetary policy. That's my monetary policy should focus on inflation rant over. But yeah.
Yeah, but the other view is that the climate change could directly or indirectly have some macroeconomic impact, including inflation. So while targeting that, we could still follow the same mandate and fight against the price stability. See, so that's. I don't know whether there is a trade-off. So it is because if we go back and we see how when the central bank, most of them did switch from the conventional to the non-conventional monetary policy to fight against the global financial crisis. This was also switching in the view of conducting monetary policy. So I don't know. So the point is about the independence of the central bank, but I agree that it's a big question. Thank you.
Thank you very much, Michael, for your reply, and Fred for your question. So if we have any other question from the audience, please raise your hand. I have several questions, but I will start with one I have in mind is about the Bank of Israel. And the Bank of Israel is announcing interest rates 8 times every year. So it means we have periods with very short time, intermeeting time, and it means that we have longer time between the meetings. And I'm just wondering how first of all, this irregularity may affect the models and the term premia and all the consequences your paper can derive. And also, how can we use these longer times, these longer intermeeting periods compared to shorter intermeeting periods? Should we play different games?
No, so you said it's 8 times a year, right?
Mm-hmm.
That's the same as the Fed.
Yeah, but we have longer periods and we have shorter periods. Even if it's the same for the Fed, longer periods may affect the term premium more than shorter periods.
No, and again, this is I think the frequency with which we need to signal big pivots or big openness to alternative policies is not going to be determined by meeting frequency. I'm fairly sanguine on the frequency of communication. There are other people out there in policy and in the literature who think we talk too much, too frequently, right? So they would say, oh, we could probably wait 12 weeks between policy decisions. It's really about the signals you're sending, and if you send the right ones, just let the market price them in for 12 weeks. We'll be fine. I don't think the one phrase you used, and you may have used it on purpose, or you may have used it just in casual language, but should we play different games? I just don't think central banks should ever play games. Central banks should be very clear in communicating that they credibly are assessing the world to the best of their ability, right? Central banks will make mistakes. Central banks will get forecasts wrong. The joy, one of the happiest moments I reached when I worked in a central bank was after I realized after a few forecast rounds that every forecast would be wrong. Once you accept that, there's a sort of calming nature that you can adopt in doing the forecast. So what are you trying to do? You're trying to form the best possible belief now. You're trying to understand carefully where you might be wrong. You're trying to assess what the right balance of, the sort of risk management approach to policy. Where could we be wrong? What could I do differently? How should I behave? with that in mind, you don't want to play games. You want to communicate this stuff consistently. Now, Jonathan, if you and I are on a committee and I think, one view and you have another, I don't think it's games playing when you come out and argue a different view. I think that's really healthy, because I might have formed the best possible benevolent, social welfare maximizing view of the world in my beliefs, but you are acting the same. So long as we're sort of good actors, no games are necessary. We just need to communicate. So then the question is, let's go back to your original question. What's the frequency? Do we want to update every time a new survey comes out or a new bit of data? No, probably too high frequency. Do we want to wait 6 months or a year? Probably too low frequency. So there's somewhere in between. Now, if you have periods where it's 4 weeks and others when it's 8, I don't think we're in the quantum where it really makes that much difference. What I guess I would worry about is if you're not updating regularly after big news, right? So most central banks retain the power to act outside of their schedule. So the Fed has conference calls, the Bank of England has emergency meetings if they need them. And I think that's an important power to retain, but it should be emergency, right? It has to be pretty big news that comes out, next week, that you go, gosh, I can't wait 4 weeks to absorb this, assess it, and come back with a good answer. And that's my view. I think we're about, the only complaint I have now I'm going to give one complaint about these different horizons. So the Bank of England used to be monthly. Actually, the very start, little known fact, the ECB was every 2 weeks initially, and then they went to only making policy decisions every month. We've moved towards more central banks having the 6 to 8 week gaps. My only annoyance with that is for time series econometric reasons, right? We have months where we don't have decisions. That's a little bit annoying.
Exactly.
That's a researcher's answer to a policy question.
No, I agree. I do agree with that. But my question, the game question, was more related to the risk premium and how we could manage the risk premium better according to the frequency. But that's fine. I mean, it's related maybe to the second question I have. So you started your presentation with the differences between the Taylor rule and what happened, the errors, the monetary policy shocks, perception. There are a lot of definitions, and you choose 2 definitions. You put aside model errors, you put aside limited information or real-time information issues we have in the literature. My question is more, no, today we have average inflation targeting, which are clearly not modeled well by the Taylor rule you used. So do you think we can use your model now to assess the current monetary policy average inflation targeting policies?
So the model is not for normative assessment purposes. The model is just to highlight that if you and I form, for whatever reasons, different views on the interest rate, you're going to think I'm making a mistake. Now, why do I have a different parameter or whatever? Maybe I take averages over a longer period or a shorter period, and you think it should be shorter, I think it should be longer. There could be all sorts of reasons. Maybe I'm genuinely just an idiot, right? You go, they put an idiot in charge, and he's going to make dumb decisions. So I don't want to say that we ignore that stuff, but there's all sorts of reasons, structural, well-modeled reasons that you could have for why you and I differ on rates. We don't model them because there's too many of them, and we're not trying to give a normative model that says this is why there's a disagreement. Just to say that in a world where we do disagree, if you worry that I'm really making big mistakes, if I can convince you I'm not an idiot and I'm benevolent and I'm doing the right thing and I'm working my best to understand the world and I am thinking about what you're worried about, I can reduce how much you worry that I'm making big mistakes. That's the key message. There's 1,000 reasons why we could differ. I just couldn't model them all.
Okay, I see. Okay, thank you very much. Do we have any additional questions from the audience? Okay, Michael, thank you very much again for this excellent presentation and paper, and we wish you a lot of success with this paper and your other researches. Thank you again, and we hope to see you here soon for very good policy-oriented research you have.
Great to talk, everyone. Thanks for the questions. Cheers, everyone. Bye.